Hello, and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m.-ish in the beautiful Pacific Northwest on Thursday. I am in the fabulous studios of New American Funding. Directly behind me over here, my colleague and friend Dana on the other side of the screen, of course, and we are live on Facebook. Hope everyone's doing great. Hope you are feeling good. Hope you're staying healthy. Hope you're staying safe. Hope you're staying sane in a relatively insane world. I was going to throw some Spanish at you guys, and I just totally lost my whole Spanish train of thought, because while I am learning, and that continues to be something that I'm excited about and continue to work with, it's certainly not natural for me. So it's not coming out the way I wanted to, although it's coming. And so it's only been a few months, and I can't wait. I can only imagine what I'm going to be like in a year after continuing to practice and talk and do the Duolingo thing and everything else. So anyway, one of these days I will do more in Spanish, but none of you wants to hear that anyway. So let's just jump right in and talk about what's going on in the world of real estate, residential real estate specifically, mortgage lending, the economy in general. Where are we going and what are we doing and what's happening? Let me tell you that February has not been a great month for mortgage interest rates and for mortgage lending in general. We were going in the right direction, and in the big picture, we still are going in the right direction. What does that mean, in the right direction? Well, we want lower interest rates, of course. We want to see inflation get bottled up and contained. We want to see mortgage interest rates come back to closer to where they were a year ago, which started with a 3. I think most of us would be happy to see them start with a 4 right now. Even a 5, for that matter, would be a welcome relief. And we were going in that direction. We really were. And the month of February rolled in, and a few things happened along the way that really caused some grief for our interest rates and for the economy in general. And I'm going to talk about what those things are, because they're not real. Of course, the damage is real, but the outcome or the input into what happened is a little bit bogus, if you will. And it bothers me. It pains me, because it has real life implications and real time implications. So if you're in the market and you're literally buying a home and you need to lock in your interest rate, and some bogus employment or jobs number comes out 2 weeks ago, and it hits the market right between the eyes, and everything goes weird, well, that's going to have an impact on your interest rate. And there's not a whole lot that any of us can do about that. It's just one of life's very, very unfortunate, very strange timing episodes. So things are, in fact, getting better, but it's not a straight line down. As far as interest rates go, they're going to come down, then they're going to level off, then they might even tick up a little bit, then they might come down and then come down more and then level off and then go back up. And then, but in time, that graph is going to look more and more favorable, with interest rates going in the right direction. So let me explain what happened and why it matters to us. First of all, at the beginning of the month, I believe it was the 3rd of February. I don't have a calendar in front of me, and it's not memorized in my head, but it was the first Friday of the month of February. We had the jobs number come out, the employment or unemployment number come out. Now, keep in mind that the Federal Reserve Board, which is working to salvage its reputation and bring down the rate of inflation, because they totally dropped the ball on this, right? And I was among the people that thought that they had their arms around the rate of inflation in 2021 and into 2022. Well, they clearly have failed, and now they're trying to play catch up. But one of the things that they want to do is see unemployment go up. I know that sounds really unfriendly and unkind, that they want to see people lose their jobs. But when unemployment rates go up, what happens is that employees, workers, do not get as much money in general. When there's a really tight labor market, when you can't get people to work, then you got to throw money at them in order to incentivize them to come back to work. And so you give them signing bonuses, you give them hiring bonuses, you give them increases in pay and things of that nature, with the idea that you're going to bring them back into the workforce. And when you do that, what ends up happening is you put more money in their pockets. And for the employees, and I am also an employee, and guess what? I like money too. The world works on money. Money makes the world go round, as the old saying goes. So when you've got low unemployment and you've got companies competing for qualified employees, what ends up happening is the way they beat the other guys out is by offering more money. And more money in circulation is exactly what the Fed is trying to eliminate, because more money chasing the same amount of goods and services leads to higher prices on those goods and services. And that is inflationary, or at least this is how the Federal Reserve Board and the powers that be in our governing class have defined inflation. And so in order to contain inflation, put it back in the bottle or the box that it came out of, they want to see that there's less money in circulation, that there's fewer dollars chasing those same goods and services when there's not as much money to be spent on goods, services, what have you. The price of those goods and services necessarily has to come down because there's still market equilibrium between supply and demand, or between cost and funds available. And as the price comes down, presto changeo, the rate of inflation comes down. So the Federal Reserve, and they've said this themselves in their comments to the media and the things that they've written and the interviews that they've given, they want to see more unemployment, more people not working, basically. Well, that first Friday in February came out with a blockbuster of a number for unemployment, showing that hundreds of thousands of new jobs were created. The rate of unemployment was supposed to go up. So it was supposed to go to like 3.6 or 3.7% from a percentage of 3.5. It actually went down to 3.4%. And the markets did not like that. The bond market, which is where mortgage interest rates really are generated, did not like that, because it is suggesting that inflation is tougher and is stickier than we'd like it to be, and it's going to be with us for longer. So the bond market sold, and when you sell bonds, the price of the bond goes down and the interest rate that it yields goes up. And so the interest rates on mortgages started a U-turn, and they were heading in the right direction, and then they started coming back up again. That happened the first Friday of the month of November, the first Friday of February, and it carried on into that next Monday. So right off the bat, we already had some really negative trends in the markets. And I'm going to show you this if I can. Y'all bear with me, because you know I am not the most technically savvy. So I'm going to try to share something here with you. Of course, it's not here. So gosh, I'm gonna not share it with you. That's unfortunate. Let me see if I can get this thing back up, because what I want to show you is a chart. There it is. Let's see if I can get it again. Hold on one second. We're working. Hopefully you guys can still hear me. And let's see. Dana confirms that my blathering is still on. Look at this. You guys are going to love it. Boom. Can you see my screen here? I hope you can. I'm sharing with you real-time market information about not the bond market per se, but the universal mortgage-backed security market. I'm being told that that it's not shown up. Oh, now it's up. Cool. So a little bit of delay, but hey, better late than never. Okay, so this is, let me show you, universal mortgage-backed securities for the 30-year mortgage, basically. This is, if I was to create a financial instrument like Tesla stock or Amazon stock or whatever it is, it's going to have a chart of the price of that particular commodity or that particular security or equity or investment opportunity. Well, what I create is a mortgage-backed security. I'm a very, very, very small piece of that big picture, but that's what we create in my office, in my company. And for that financial instrument, this is the actual real-time price of what it is that we create. This is a chart, of course, and it shows the cost of the instrument, or the the bond that we create basically. Now, if you look down here, there's a calendar, and this right here is the beginning of February. And notice what has happened since that unemployment number came out. This is the price of the instrument that we create. It has gone way down. It has lost a lot of value over the last 2 weeks since this month began. And as a result of losing value or losing price, bonds are weird. Mortgages are weird. Mortgages are bonds, by the way. So when I say bonds, mortgages, in this example, they're kind of interchangeable. But when the price of the bond goes down, the interest rate goes up. And so if you'll notice, we were doing pretty good here coming into January, the brand new year, 2023. We're rocking and rolling. Everything's good. This was my birthday, by the way, January 30th. And we had some nice upward movement on price. And then we hit that jobs number. And boom, everything started coming down, and it continues in a downward trend right now. And let me tell you how frustrating that is for me, because the jobs number that came out early February was kind of bogus. They changed. What I mean by bogus is they changed the metrics. The people, the institution, which is the Bureau of Labor Statistics, the institution that calculates this particular number, changed how they calculated it. It's the first time they've done it, and they created a brand new sort of math. And in the course of doing that math, they started counting all sorts of second jobs and part-time jobs and seasonal jobs and all sorts of things of that nature. They counted them. Now, this is for the month of, I want to say it was for the month of December. It might have been for the month of January, but whatever it is, the numbers were cooked. The books were cooked, and it had the impression of showing that the economy and the job market is significantly stronger than it was. But when we dig deeper into the numbers and we look at how they calculated and tabulated all of these results, we can see that the Bureau of Labor Statistics was a little bit indulgent, shall we say, in how they came up with these numbers. But no matter. I mean, we can stomp our feet and hold our breath and cry about it, but at the end of the day, the damage was done. As you saw in that chart, the markets responded very, very negatively, and the price of the bonds went down and the interest rates started going up. Well, follow that up with this week, we had the Consumer Price Index that came out. Now, the Consumer Price Index is a measure of inflation. Again, everything that we're talking about with interest rates, everything is about inflation. When inflation comes back down, interest rates will follow suit. So this may be boring to you guys. I totally get it. It's economic, it's macroeconomic, it's big picture stuff, but this is what is driving interest rates. And if you're interested in buying a home, refinancing a home, investing in investment properties or whatever it is, or you sell real estate, interest rates kind of matter. So I'm going to focus on this. Earlier this week, the Consumer Price Index came out. I believe that was Monday, maybe Tuesday. I think it was Tuesday. And the Consumer Price Index, they also changed the numbers. They changed how they calculate the numbers on the Consumer Price Index. And they they increased the weight measure of one of the components. So one of the big components of the Consumer Price Index is the cost of shelter. That includes rent. And it also includes some really weird calculation to create the rent equivalent of people that own their homes. So I own my home. I don't pay rent, but I pay a mortgage payment and other, obviously, taxes and insurance and other things. And the folks that calculate these statistics on the cost of shelter, which is a component of the Consumer Price Index, these folks have some calculation to create an equivalency of my mortgage payment as what it would look like if I was paying rent instead. In any case, this is a huge component of the CPI. Consumer Price Index is made up of a variety of different things: used cars, medicine, travel, hospitality, restaurants, things of that nature, and the cost of shelter. Now, up until this last week, the cost of shelter made up 39% of the total number that goes into consumer price index. So a really big percentage of that. Well, the powers that be decided that wasn't big enough. So they upped that number to now 43%. So 43% of the entire consumer price index measure is made up of the cost of shelter. And I get it. Shelter is a really important thing. Totally get that. But the cost of shelter is a very hard number to pin down. Think about this exact number or this calculation like a roller coaster train. When you sign a lease, you're signing that lease in theory for 12 months. That's the common, typical. Yes, you've got short-term lease. Yes, some of my tenants actually have a 2-year lease. They negotiated really well. And so you've got that as well. And you can go month to month, but that's really expensive. But you guys who are renting or have rented in the past, you know that 12 months tends to be a standard sort of amount. And so when you sign your lease or your renewal is going to fall different points of time over that 12 months, right? I mean, I've got tenants that signed a lease in October of 2021. Well, that's going to expire in October of 2022 in theory, right? And so you've got a 12-month sort of span. But the way the powers that be look at the cost of shelter, specifically as it relates to the term of leases, it's weird, it's wonky, and I can try to explain it to you, but the best way I can explain it to you is by thinking about the cars on a roller coaster. I love the throw-up ride, so that's me. If we're going to go to an amusement park, I want something that's going to terrify me, and I want something that's going to turn me upside down and suck the eyeballs back into my head. I like that. But when you leave the platform on a roller coaster, you've got the front of the train and the back of the train. And the first thing it does is it goes up that giant hill, that first hill, right? And it kind of pulls you up and pulls you up and pulls you up. And you get that anticipation and you're looking off to the side and you're like, wow, we're really high up here. This is going to be freaky cool. And you get up to the top of that hill. And then the first thing that happens is you crest that hill and you go running down the other side, right? And when you do that, part of the train, that first part of the train may actually be on the downward slope, but that back part of the train hasn't even hit the top of the hill yet. That's the problem with cost of shelter, because you're doing it on a 12-month thing. I don't renew my leases every month. So we're looking there, the statisticians are looking at numbers where they might be at the tail end of that rental agreement. They might be at the very beginning of that rental agreement. They might be somewhere in the middle of that rental agreement. It's like being on a roller coaster. Part of it, they're on their way down. Some of them are on their way up still. And so how you mash that together and come up with one number that is represented as 43% of the overall rise of inflation or cost of inflation, that's really complex. And it certainly leaves a lot to be desired. Much like my explanation, probably leaves a lot to be desired. But I will tell you that it is artificial. It is not actually what's happening, but it is the only measure that we have at the moment that expresses what is happening. And so you have to take that with a grain of salt. And in doing that, guess what? The rate of inflation went down with the consumer price index on Tuesday. It did go down, but it didn't go down by as much as the markets would have liked. And as a result of that, the markets threw a tantrum. And so once again, let me share my screen with you. Let me show you what happened on Tuesday. Bear with me here. This is in real time, so live video. So this was the beginning of the month of February, and here we are on Tuesday. I think that was the 14th. Yeah, the 14th. Here we are on Tuesday. So again, when the sticks are red, that means a down day. When the sticks are green, that means an up day. So if you notice, once again, the market had a bit of a tantrum because the rate of inflation as expressed by consumer price index is not going down as quickly as we'd like it to. What else is happening? Well, today, here we are today, another sell-off. Why? Because the producer price index came in hotter than expected. Now, producer price index is a little bit different than consumer price index. Producer price index is the cost of raw materials. That's the stuff that goes into everything that we buy, basically. And this is impacted in a great degree by the cost of fuel and energy, gas, and things of that nature, because producers have to deliver goods and services to the market. And when the cost of fuel goes up, that is going to impact their costs. Sometimes that gets passed on to the consumer, other times not as much, but whatever it is, this still kind of impacts what is viewed as inflationary pressures. And so once again, the market is having a really horrible February. If you look at this, this is a downward slope. This is a negative slope. What we want to see are big giant green days like this. This happened earlier in January. That was awesome. That was a great way to start the year. We want to see more of that because as the price of these instruments goes up, the interest rate comes down. Unfortunately, right now, we got a lot of headwinds, meaning that, we're fighting all this information. We're dealing with a lot of, I don't know if it's negative. I don't know if it's positive. Certainly the impact is negative, but as I've said time and again, it's not going to be a straight shot down. This is going to take some time to unravel and to get us to a better sort of economic footing with the rate of inflation. It will get there. It's just a question of when. And that is not necessarily the happiest news for people who need to lock in their interest rates today or yesterday or whatever it is, and they're dealing with these numbers. I get that. And I wish there was something better and more comforting I can tell you, other than there will be a refinance opportunity. For every loan that we're closing right now, there will be an opportunity to refinance that mortgage in 6 months or 8 months or 15 months, somewhere in the relatively near term. There's going to be a time when these interest rates are going to be significantly better, and we're going to get a chance to refinance that mortgage. So be of good cheer. Yes, it may not be the best news right now, but big picture, it's going to work out. Here's the other thing that I want to really share with you guys and leave with you. Let me see here. Yeah, we got 7 minutes left on these 30. This is still, in my opinion, the best time to buy your real estate, to buy your primary residence. Now's the time, guys, because this will turn. It may be May, it may be August, it may be October, it may be next year, but it will turn. And when it does, I saw numbers today on the on new construction and on housing starts, housing permits. We have got nationwide and absolutely for certain in the Pacific Northwest region, we have got a shortage of residential housing units, and the builders have not built enough. They don't build that much anyway. Keep in mind, new homes make up 15% of the overall supply in the market. The rest are resold, meaning that it's your home that you sold because you're moving into a condo, or you're moving to Cabo, or you're moving to, somewhere else. 85% of our market is made up of resale homes. And in the Seattle Pacific Northwest region, I would say that's probably closer to 90 or even more than 90% of our market, because we don't have huge home building initiatives like they do in states like Texas or Arizona or Nevada, or where there's a lot of usable real estate. So we don't have a lot of new homes. But here's the thing, across the country, across the board, new home permits and starts are way down, meaning that there's like 1.3, 1.4 million permits and new homes being started. There are 1.9 million new households being formed. I won't bore you with all the details of how household formations are tabulated, but I will definitely tell you that it is the household formation that drives the demand for residential real estate. When you have a new family unit, when you leave your parents' home, when you leave the dorm that you were living in college, or the apartment that you are renting, and you now decide that you need to buy a home, that is a household formation that is going to be looking for residential real estate. And there is a major imbalance, meaning that there are 500,000 more new households being formed right now today than there are new homes being built. 500,000. That's a large number, no matter where you are. And so when these buyers hit this market, and I don't know if that's going to happen tomorrow, I don't know if that's going to happen next month or at the end of this year, beginning of next year, that's a crystal ball I just don't have. But what I do know is that they will hit this market. And when they do, they're going to generate the kind of demand and the kind of insanity, as my wife likes to refer to it, that we experienced in 2021. Multiple offers, right? offering to pay more than the seller is asking in order to beat the 15 other interested parties, not having an inspection on the property, eliminating your safeguard in case of a problem with the financing, so waiving your financing contingencies. All of these things that we experienced in 2021, myself included and my real estate partners on the other side of the screen, we had a great run in 2020 and 2021. It was very active. It was very exciting, but it was also painful. I remember a lot of clients wanted to buy homes and just couldn't. They wrote an offer and they were rejected. They wrote an offer competing against 20 other offers and they were not even in the top 5 in some cases. That's painful. That was painful then. It's going to be painful now when it happens again. And it will happen again because we've got, as I said, 500,000 more buyers than we have available supply. What do you think that's going to do to supply and demand? All you folks out there who think that there's going to be a housing crash and who think that you're going to buy homes on a 30% or 50% discount, that's not going to happen. There are way more people willing to buy at market prices today, if not higher, than there are homes available for sale. And regardless of what we want to believe, basic laws of economics, supply and demand, pricing support, things of that nature will keep everything kind of normal, whatever normal looks like, but you're not going to see what we saw in 2008 and 2009. I will stake my reputation on that. We may see something, but it's not going to be people walking away from homes they've got tons of equity in and saying to someone, hey, buy it from me for 50 cents on the dollar, or let me just hand it back to the bank and walk away from the loan. That is not going to happen. That was a once in a lifetime moment. That moment is past. Other things may happen, but they will not happen like this. So as we're about to wrap this up, my advice to you guys, whether you're buying a home, considering buying a home, a real estate broker, working with people who are on the fence about buying a home, today, right now, is the best time. I'm not saying it's our last opportunity, but I am saying that right now, we're already feeling the competition starting to perk back up. We're seeing multiple offers. Certain homes are getting offers above asking price. That's happening right now. Soon enough, it's going to happen across the board. So before it does, this is your opportunity to get in early. Y'all want a good deal. This is the good deal. This right now is the good deal. We'll refinance that mortgage in a year, 18 months, 6 months, whenever the opportunity comes. But this is the time to not have to pay 10 to 20% above what the seller was asking. That happened in 2021. I'm willing to wager it's going to happen again sometime in 23, maybe in 24. It's going to happen again. So if you want to avoid that, if you want to get in with the smart money, now's the time to do that. As such, I urge you, please call me. Call me. Let's talk about it. Let's talk about what you can qualify for. Let's talk about what lending looks like. Call your referral, your real estate partners, call whoever it is, but don't miss this opportunity because the window is closing. Eventually rates will come down. And when they do, everybody else is going to go in the market. And it would be much better for you guys if you're already sitting pretty in your home and just waiting for those rates to come down so you can refinance. Anyway, that's it for us. 30 minutes have come and gone. It's amazing how quickly that happens. Until I see you guys next week, which I'm looking forward to, I want you to stay safe, stay healthy, stay sane. Always, please stay sane. Thank you so much for spending a little bit of time with me. I will see you next Thursday, Facebook Live. Have a great weekend. Take care.